big lesson I think we all learned during this pandemic is that healthcare corporations are very, very important. Unfortunately for us Canadians, the healthcare sector is practically non-existent in the Canadian stock market. We have a lot of financials, a lot of energy and materials, but when it comes to healthcare, not so much. That's because the biggest and most important healthcare companies in the world are primarily based in the US and in Europe. So how can Canadian investors get a piece of these lucrative and important corporations and make amazing passive income in the process? Well, in this video, I'll show you 3 Canadian listed ETFs that all invest in the biggest and most important healthcare companies in the world. I'll analyze and compare the 3 and show you how easy it is to make up to 9% dividend yield a year off these immensely profitable and important companies. The COVID-19 pandemic rages on and many people are suffering, whether it's from losing their job, losing their minds, or even losing their lives. So salvation is coming, and it's not from Jesus or whatever God you believe in, it's from science. So vaccines are finally starting to be distributed all around the world, so we can finally start conquering this disgusting disease, which I'm sure you're all sick and tired of, myself included. The whole world really has a debt of gratitude to show these scientists, medical workers, and of course Bill Gates, who have been working nonstop in the last year or so to help develop a vaccine in record time. So as a fellow human being, I really have to say thank you to them. And like I said in the intro, healthcare companies, which include pharmaceuticals, are extremely important to humankind because COVID-19 won't be the last pandemic, guys. There will be more. In addition, there are still many horrible diseases out there which will only be conquered by science. So these corporations are very important, but they are also very profitable. You think they're going to give away their life-saving medicines and vaccines? I don't think so. On the contrary, they could actually pretty much charge what they want. I doubt there was much negotiation between Pfizer and the federal government of Canada for their vaccine. So I think you get my point by now, and honestly hope you really don't need further convincing that investing in these top healthcare companies is a good idea. If you've been watching my channel for a while now, you know that covered call ETFs are one of my favorite ways to make high and safe passive income off a particular region or sector of the stock market. So in this case, it's no different. A covered call ETF is simply an ETF that employs a covered call strategy, which is a zero risk way, I repeat, a zero risk way to enhance the dividend yield of an ETF. So the ETF manager simply uses a very common and conservative options trading strategy to make that happen. I won't get into the details in this video, but if you have no clue what a covered call ETF is, check out my video where I explain that in detail. In summary, or in short, a covered call ETF is really designed for dividend-hungry, long-term investors like myself who are happy to hold the ETF for a really long time without the intent of really selling it in the future. We are more interested in getting maximum passive income every single month. So I found 4 covered call ETFs listed on the TSX, so on the Canadian stock market, that really focus on the healthcare sector, but I'll talk about the 3 biggest ones out of the 4. They're very, very similar in terms of what companies they hold, but they have some subtle differences between them. So let's check them out one by one, and you can make up your own mind which one you think is the best. First ETF I want to look at is from a company called Evolve ETFs, a fairly new company. ETF provider. So the stock symbol is LIFE. It's on the TSX, and they invest in 20 of the biggest healthcare companies in the world, and of course they use a covered call strategy. So you could see here 20 holdings. The dividend yield is a little over 7% right now. And if we look at the portfolio, you could see that the bulk of it is in the United States. And some of the companies are, companies that you'll recognize: AbbVie, Pfizer, of course, Johnson & Johnson, Bristol Myers, AstraZeneca should be here. Yeah, there it is. So really the top of the top when it comes to healthcare corporations. What I like about this one, even though it's the baby of the 3 that I'm going to cover, it has the lowest management fee at 0.45%. In terms of net assets here, it's the smallest one at 66.9%. So with a dividend yield of 7%, it's a pretty good choice for healthcare corporations, and to get a really good yield, of course, because this is a covered call ETF. Second ETF is from CI First Asset, one of my favorite covered call ETF providers. It's FHI, so the stock symbol FHI listed on the TSX. So as you could see, it's healthcare giants covered call ETF. The management fee is 0.65%, so a little higher than the previous one. And if we look at the holdings, very similar. So I'm not going to go through them. Basically, in terms of holdings, all three of the ETFs are very similar. The difference with this one is that the distribution is quarterly instead of monthly, and it varies every quarter. So if we look at 2019, they've been pretty stable at 16 cents, 15 cents, 15 cents, 13 cents here. But in 2020, they increased dramatically to 30 cents, 28 cents, and the latest one that just came out is 30 cents. So the average dividend yield, or the 12-month trailing distribution yield in the last year, is 9.82. So really high. Dividend yield, really a phenomenal ETF if you ask me. A great company, and if we look at the assets, it's a little bit more than the previous one at 190 million. So another really good choice for a healthcare covered call ETF. Third, but definitely not least, this would be my favorite one, or my top choice. It's HHL, so that's a stock symbol. It's from Harvest, another one of my favorite covered call ETF providers. So in terms of holdings, we won't go through them. It's really pretty much the same type of companies. What I like about this one, although that the management fee is a little bit higher at 0.85%, what I like about this one is that the dividend, or the distribution, is basically the same every single month. So Harvest basically has a unique covered call strategy where they always sell enough covered calls to come up with the same exact dividend every single month. And it's been the same since 2015. So really consistent. And right now the dividend yield is it's about 9%, if I could find it here. Yeah, so it's a little over 9%. So unlike the CI First Asset one, it's very consistent with monthly dividends every single month. In terms of the assets, it's the biggest one by far. It's actually Harvest's biggest and most popular ETF. It has a little over 400 million in assets. So definitely the biggest one here. And just to show you guys the 1 year graph for all of these, so you have the life one here, CI First Asset, and HHL. If you look at the 1 year graph, they're pretty much all identical. So as you can see here, a little dip with the COVID and then back to normal. That's with the life one. For the CI First Asset, a little dip, then back to normal. HHL, a little dip, back to normal. They look exactly the same, and it makes complete sense because they have pretty much the same company. So there you go, guys. There are the three ETFs I want to show you. So there you have it, guys. Easy peasy. Owning any one of these ETFs is a great way, in my opinion, to invest in the essential, powerful, and lucrative healthcare sector as a passive income-focused investor. Not only do you get exposure to the best healthcare corporations worldwide, but you get a really nice dividend yield as well. So covered call ETFs are perfect for long-term buy and hold investors like us who want to maximize their income. I have fallen in love with this sector of the stock market and invested $20,000 of my own money in HHL, which gives me about $150 a month in easy, hands-off passive income. And I'm planning on investing more in the future. I like the fact that HHL has a high dividend, a consistent dividend, and a monthly payout. So FHI from CI First Asset, however, is starting to get my attention because of the higher dividends like we saw in the last couple of quarters. But will they stay high or return to previous levels? I'm pretty sure that the recent increase of quarterly dividends is because of stock market volatility. What do I mean by that? Well, don't forget that volatility in the stock market, so when it goes up and down crazy, is good for covered call ETFs because option premiums are more expensive to buy, which simply means that the covered calls that are sold by the ETF manager makes us more money. So in the meantime, while I wait, the winner is HHL for me. You can of course invest in all three. It's really up to you. The important thing is that you invest. So if you learned something from this video, guys, please hit that like button. I would really appreciate it. Let me know what you think, or if you have any questions, leave them in the comment section below. As you all know, I'm more than happy to answer all of your questions. So if you like my passive income focused investing strategy, make sure you're subscribed because I have a lot of similar content coming up. Investing for passive income is what this channel is all about. So we also started using community posts, which you only get if you're subscribed. These posts will keep you updated on any major news for the stocks and funds that I personally cover on this channel. So we're also on Instagram, by the way, so you can follow us there. And we're also working on a brand new website for you guys where you'll be able to access many free tools and which will help you in your investing journey. So my mission remains the same. It's to help everyday working Canadians to invest on their own, to build their own stream of passive income to enhance their quality of life. So with that, take care, guys. Thanks for watching. Happy holidays. Of course, stay safe and see you next time.